For years, investors believed Bitcoin's biggest purpose was simple: protect your wealth from inflation. That was the story after the 2008 financial crisis. Governments printed trillions of dollars, central banks slashed interest rates, and Bitcoin emerged as an alternative monetary system that couldn't be manipulated. But according to investment strategist Jeff Park, that story is evolving. Jeff Park has become one of the most respected macro voices in the Bitcoin space because he isn't just focused on price predictions. He studies the bigger picture: global debt, monetary policy, artificial intelligence, and the long-term forces reshaping the financial system. And his latest warning isn't about Bitcoin reaching another all-time high. It's about what happens to people who own none. Park believes we're entering a new era where Bitcoin isn't simply an investment anymore. It's becoming protection against a world where currencies continue losing purchasing power, artificial intelligence centralizes more economic power, and financial systems grow increasingly fragile. In other words, the greatest risk may no longer be buying Bitcoin. The greatest risk could be ignoring it altogether. And that's exactly why Bitcoin FOMO is becoming something very different from the speculative frenzy we've seen in previous bull markets. This isn't about chasing quick profits. It's about understanding one of the biggest financial shifts of the next decade. Which brings us to a question almost nobody is asking. What if the biggest threat to your financial future isn't inflation? Isn't the stock market? And isn't even losing your job? What if it's something much bigger? What if the rise of artificial intelligence is quietly creating a world where your data, your work, and even your money become controlled by a handful of massive corporations? And what if the one asset designed to resist that future has been sitting in plain sight this entire time? Most people think Bitcoin is simply a speculative investment. But a growing number of investors believe Bitcoin is becoming something far more important. Not just digital gold, not just an inflation hedge, but a financial life raft in a world where technology is changing faster than society can adapt. And once you see why, you may never look at Bitcoin, or AI, the same way again. For years, Bitcoin supporters argued that it existed to protect people from governments printing endless amounts of money. That story made sense after the global financial crisis. After all, Bitcoin was born in 2009, just as central banks flooded the economy with newly created currency. Its mission seemed simple: protect wealth from currency debasement. But something has changed. Today, an entirely different crisis is beginning to unfold. Artificial intelligence isn't just disrupting jobs. It's challenging the relationship between people, data, ownership, and power itself. And here's the fascinating question. Could AI become the very reason the next generation embraces Bitcoin, not because of inflation, but because of freedom? To answer that, we need to understand where this story really begins. Back in 2011, thousands of Americans filled the streets during Occupy Wall Street. People were angry. Banks had been rescued. Ordinary families had lost homes. Young people graduated into one of the worst job markets in decades. The message was simple. The financial system wasn't working for everyone. Bitcoin quietly emerged from that exact environment. It wasn't designed by politicians. It wasn't created by banks. It wasn't controlled by corporations. Instead, it introduced something completely different. A monetary system where no single institution could print more money whenever it wanted. For millennials, Bitcoin became a protest against inflation and reckless monetary policy. But Generation Z is growing up in a completely different world. Many aren't worried about buying homes because home ownership already feels impossible. Instead, they're watching AI transform industries almost overnight. They're seeing algorithms create art, write code, produce music, replace customer service, generate videos, even perform tasks that once required years of education. The question they're asking isn't, can I buy a house? It's, will my skills even matter? And that's where this story takes an unexpected turn. At first glance, artificial intelligence and Bitcoin seem unrelated. One is software. The other is money. But beneath the surface, they share something surprisingly important. Both consume enormous amounts of energy. AI requires massive data centers filled with powerful processors. Bitcoin requires miners securing the network with computational power. In other words, both transform electricity into something valuable. One creates intelligence. The other creates monetary security. But here's where things get interesting. The economic incentives behind those two systems couldn't be more different. AI today is becoming increasingly centralized. The world's largest technology companies are collecting unimaginable amounts of data. Every search, every conversation, every image, every click, every preference. That information trains increasingly powerful AI models. The better those models become, the more valuable they are. But who owns the value created from your data? That's becoming one of the defining questions of our generation. Imagine spending years creating photos, videos, artwork, articles, software, conversations, and ideas online. Now imagine artificial intelligence learns from all of it. It becomes smarter because of millions of people like you. Then, that same AI begins replacing jobs. Who gets rewarded? Today, mostly the companies building the models. Not necessarily the people whose information helped create them. That's why some investors believe decentralization is becoming more important than ever. Bitcoin introduced the idea that no single authority should control money. Crypto expanded that idea into ownership itself. Ownership of digital assets. Ownership of identity. Ownership of information. Ownership of value. And suddenly, those ideas feel incredibly relevant in an AI-driven future. Because if AI centralizes power, crypto attempts to decentralize it. The debate isn't simply about technology anymore. It's about who controls the future. This is where Bitcoin enters the conversation in a completely different way. For years, critics argued Bitcoin had no real use beyond speculation. Supporters answered that it was digital gold. But increasingly, some investors believe Bitcoin's greatest value isn't simply protecting purchasing power. It's protecting independence. Think about what happens during periods of aggressive money printing. Currencies lose purchasing power. Savings buy less. Asset prices rise. Those who own scarce assets often become wealthier. History has repeated this pattern many times. Gold benefited. Real estate benefited. Stocks benefited. And more recently, Bitcoin joined that list. Unlike traditional currencies, Bitcoin has a fixed supply. Only 21 million will ever exist. No emergency meeting can change that. No politician can vote to create more. No central bank can increase the supply because markets become difficult. That's an entirely different monetary system. But here's where things become even more compelling. Many people ask, isn't Bitcoin already too expensive when Bitcoin traded below $1? People said it was risky. At $100, they said they missed it. At 1,000, it seemed impossible. At 10,000, it looked expensive. At 50,000, people waited for a crash. Today, the same question remains. Have I already missed my opportunity? Some investors argue that's the wrong question entirely. Instead, they ask, what happens if you own none? Because if Bitcoin continues becoming a globally recognized store of value, not owning any exposure becomes a risk in itself. In investing, every portfolio makes choices. Owning an asset is a decision. Ignoring an asset is also a decision. That's why many professional investors no longer debate whether Bitcoin should exist. Instead, they debate how much exposure makes sense. Not because it's guaranteed to outperform everything else, but because its behavior often differs from traditional assets. That diversification alone may become increasingly valuable. And there's another reason. Government debt continues expanding. Fiscal deficits remain historically large. Many economists believe lower interest rates eventually become necessary to sustain that debt. If that happens, assets with limited supply could once again benefit. No one knows exactly when. No one knows exactly how. But the possibility is becoming harder to ignore. At the same time, some investors remain optimistic about America itself. They believe innovation will continue driving economic growth. Artificial intelligence, stablecoins, technology, capital markets. These could strengthen the US economy even while monetary policy evolves. That creates an interesting investment framework. Bitcoin for scarcity. Dollar-producing assets for income. Rather than viewing them as enemies, some investors see them as complementary. One protects purchasing power. The other generates cash flow. It's a balance between offense and defense. Of course, no serious discussion about Bitcoin would be complete without acknowledging the risks. Bitcoin remains volatile. Price swings of 20, 30, or even 50% have happened multiple times. Governments continue developing new regulations. Technology changes rapidly. Competition inside crypto remains intense. And many decentralized AI projects are still experimental. Critics also point out that much of the crypto industry has overpromised and underdelivered. Countless projects have failed. Billions of dollars have disappeared in scams, hacks, and speculative bubbles. Those concerns are real. It's easy to become excited about decentralization. It's much harder to build systems that actually work. The future isn't guaranteed. Bitcoin could continue growing. Or it could face challenges nobody expects. That's why diversification, risk management, and long-term thinking remain essential. Investing should never rely entirely on one prediction, even one as compelling as Bitcoin. The world is changing faster than almost anyone imagined. Artificial intelligence is rewriting industries. Governments continue expanding debt. Technology is reshaping how people work, create, and earn. In the middle of all of it, Bitcoin sits at the intersection of two powerful forces: money and freedom. Maybe Bitcoin isn't simply about replacing banks. Maybe it's about giving individuals ownership in an increasingly digital world. Maybe decentralization isn't just a philosophical idea anymore. Maybe it becomes one of the defining economic battles of the next generation. No one knows exactly how this story ends. But history has a habit of rewarding those who recognize structural changes before everyone else. The question isn't whether AI will transform the future. It already is. The real question is, when that future arrives, will you own part of the system controlling it? Or will you own the asset designed to exist outside of it?